Well, let's welcome in Venugopal Garre. He's Managing Director, Bernstein. Venu, great to have you with us here. Good morning. Good to have you as always. Now, it's a market where you really don't want to stand in the way of momentum or the sentiment, which is very, very upbeat. At the same time, I mean, would you struggle to find large pockets of very clear undervaluation, Venu? So how does one approach things now? Go on.
Thanks, Prashant. I think you have summarized it well. When we start running out of bottom-up ideas, that is when we start to worry about market levels. At the same time, the flow perspective, especially FII flow, seems to be fairly decent. And I think India is also emerging as a very important sort of a country in the overall emerging market basket, which is basically another aspect which needs to be debated, whether it's a short-term sort of a view or a structural view that investors are taking. A lot of these flows essentially then leads to this positivity and momentum, which is what we are essentially seeing in the markets today. Now, our view primarily has only changed modestly. I mean, in some way, I didn't want to really stay away or stand in the way of momentum. About 3 months back, you would recall, last time when we were discussing, we had upgraded India to sort of a buy with the view that index should go to 18,500 levels. Now, that was actually an year-end view, and we ended up seeing that happening in 3 months, or less than 3 months. Now, at this situation, I am of the view that I use this term called positive pause, which primarily means that I'm not looking for a deep correction in the markets, but there is a possibility that we hover around a similar range for Nifty, with room for short corrections happening, episodic factors driving those. At the same time, I think that the broader markets outside of the index stocks probably will continue to see momentum, which is where I guess people would seek opportunities, in terms of investment. So that's the broad roundup view of what I think about, at this juncture from a top-down level on India.
So you spoke about a positive pause in the market. So perhaps what we call a time-wise correction, right? Not so much a price-wise correction. Got that. Venugopal, morning. I have to ask you what's happening with the banks because, there's a steep fall that we've seen in the month of June. Stocks like Kotak Mahindra Bank are down 10% already. And we're not even done with half of the month or with the entire month, rather. What do you do at a time like this? Do you buy this dip or do you stay away entirely from the private sector banks?
My viewpoint is, I think the market's viewpoint primarily is very centered around how they're looking at, the top-down valuations as well. The general thinking is that, larger banks, given what our expectations of credit growth this year, the lack of room for earnings upgrades, for example, doesn't really necessarily mean earnings downgrade revisions, but essentially about lack of room for earnings upgrades and where they are on valuations. I think there's a broader thinking that perhaps they're fully valued, which is what is broadly reflecting in the underperformance, which has basically happened year to date. Now, my viewpoint is that, given a slightly positive view that I have over I would say a 2 to 3 year view, or even a 12-month view, I would be a buyer of these sort of declines in some of these large cap banks. And my perspective simply is that if people think about red flags, this is more about the broad basing of credit growth. Now, so if you were to think about it, if consumption, things like unsecured lending, if that has been essentially been the drivers for credit growth, eventually it has to move and become more industrial-led, not necessarily just industrial working capital led by inflation, but more industrial led by capex. And these things essentially take time. But I think the market comfort would essentially come through when that transition happens. Now, this transition essentially on its own will not happen in 3 months. It is going to take about a 12 to 24-month view. So if you are essentially looking at playing that trade, I think it is a good opportunity to essentially buy into these banks. They've underperformed. And I think the cycle is going to be positive for them over a 3-year view.
Okay, so keeping the faith on the banking side of the market, Venugopal, hi, good morning. Let's talk consumer as well, because I guess that's where everyone's now trying to see if this rural revival is for real, but we have questions on the monsoon right now. So, A, what's your overall thoughts and sort of positioning on the consumer side of the market? And if you could break that up between urban discretionary and let's say some of the more ground level rural FMCG part of it.
Yeah, so I mean, consumption has various subparts to it. I think on an overall level, I am still sort of underweight on consumption. And in the sense that from a growth standpoint, my viewpoint is consumption may not necessarily throw major positive surprises. And remember that the start for the monsoons has not been that great. So there are some risks around what might happen to agri GDP growth rate, which is, of course, got a deep link with how monsoons shape up. So at the margin, what we saw positivity in terms of rural spends in the initial part of the year, perhaps we could see a situation where things might moderate, in the next 2 or 3 months. Now that's essentially probably, worrying sign. Now, I would probably argue that within these elements of broader consumer, the areas which I have actually been pushing or been positive on are more linked to things like appliances or electrical products, which could be those products associated with the real estate. So that's an area essentially I'm positive and overweight on. That's a change that we had made a few months back. FMCG in general, very hard to argue for incremental positives given where they are on the valuation cycles. I would still be underweight pure FMCG. Autos, which is another leg of consumption. This part, I was more neutralish and trying to play with certain stocks in the basket. Of course, it's a positive sort of a view on autos, but neutralish because of specific, sort of areas where we weren't really positive on. But at this juncture, I think we're reaching a situation where it's becoming hard to digest even valuations for autos across the board. So incrementally, I guess the returns will be quite relatively more muted even in that particular sector. So that's a broad, probably picture I would sort of place. If at all, I would probably argue that discretionary outside of all this, I guess might still be a bit sluggish because inflationary risks, while, sort of are receding, but then aspects such as inflation rearing up back again because of food and other things might be a risk which might play out later in the year.
What about some of these spaces that have come back after a long time? I mean, defense, of course, has been the flavor of the season now. But there are so many other pockets, right? Auto ancillaries have come back in a big way. Electric vehicles, we were just discussing that theme a while back. Anything that you like from these so-called new age themes?
No, I think we like a lot of these themes, but there are some themes which are getting priced in. For example, defense, I've been positive on it for almost a decade. And looking at where they are currently on the valuation curve, very simplistic view, if you were to think of defense, the idea was that indigenization essentially will drive faster growth for local companies, especially the SOEs. If you were to look at 8-9% long-term growth historic from a top-line perspective for the overall defense spends on the capex side of things, now these companies are already pricing in more than double of that. Look at where they are on valuation curve. So I think the defense theme is fizzling more for me from a point of view of valuation than essentially the story itself. The second theme, essentially on the EV side of things, I'm very, very positive. I would be of the view that mainstream EV companies are yet to emerge. So people are trying to essentially play whatever is linked to EVs at this juncture. And one should be really cognizant of that. Essentially, some companies which are just assemblers and conduit for Chinese companies, without mentioning those names, I think one should be extremely careful about sustenance of those rallies for those companies. I would still wait for some of these incumbents and mainstream EV companies to emerge to essentially call that as a relevant sector. Manufacturing is another area where I'm really positive on, especially the China Plus One theme. There would be broad basing of opportunities essentially that I see around that as well. And that's a pretty long-term theme, so you will always see volatility around that. So these are probably the three things that I want to mention as the areas. So,
Venu, have you? The institutional investors, they have certain criteria in terms of market cap, volumes, etc. And that kind of, in a market like this, because there are newer sectors emerging as well, right? Smaller companies which cater to, as you yourself said, one has to be more careful there because they're not established in the electric vehicle space, for example, and other areas. So, I mean, do investors want more ideas down the market curve? I mean, just trying to understand, because there is new energy, there is electric vehicles, defense, for example, there are lots of smaller companies, not the big ones like BEL, where there is institutional coverage. But is there interest down the market cap curve?
Yes, Prashant, I think somewhere down the line, I think broadly, globally, investors have realized that one of the most important ways to play India as a story is not just through large caps. Otherwise, it always used to be the top 50 or 60 companies. So the interest in trying to achieve those opportunities where you could essentially sit with companies and get your multi-baggers essentially comes through the next 50 or the next 150, right? So we don't really see too much of interest in a 300th rank market cap stock, but essentially outside of the top 100, the next 150, there is immense interest because people do still want to essentially achieve some part of the portfolio linkage to those sort of stocks, which can essentially give them, sort of the extra return over the index. So that's, I think, given. And I see that actually getting broad-based across the world. So that's the situation at this juncture. But at the same time, I would probably argue that, somewhere down the line, these new opportunities that come through, there are some areas where I see much more tangible interest. So for example, something like EVs, there is always active participation in trying to figure out what to buy. Similarly, manufacturing in general, fairly active participation. Manufacturing could be EMS or could be an existing manufacturer doing, let's say, even chemicals, right? So that's like a fairly broad industry. But, at the same time, new energy, I think there is a divided opinion in terms of quality of companies and what to play, whether it should be a utility or a manufacturer. And I guess probably, I think the opinion is very clear that people want to still figure out and play manufacturers rather than trying to play utilities because there's some always regulatory issues which emerge, right? So there people tend to discern about what to buy and what not to buy. And similarly, just to highlight EVs, as I mentioned, want to clearly clarify that while people in the lack of opportunities might be buying whatever appears as EV at this juncture, if you are a company which are just a front for a Chinese EV player, I think those are companies which won't be sustainable. Eventually they will find regulatory issues.
All right, we'll leave it at that. Thanks a lot for joining in, Venugopal. Appreciate your thoughts